quarter of a point, David.
Yeah, this was largely expected, Katie, going into this meeting. It's what Wall Street thought would happen here. And the reason for it is there is a sense on many members of this committee that the Fed is a bit behind the curve here when they look at the labor side of the Fed's dual mandate. So for so long, really since COVID, a huge focus has been on the inflation picture, and inflation remains higher than the Fed would like it to be. The target is around 2%. We're still removed from that. But in recent weeks, we've seen deteriorating data when it comes to the jobs market, when it comes to the labor market. And I think back on the monthly jobs data for August, the revisions that we saw to payrolls on the heels of that, weekly jobless claims. So that's made the Fed have to shift its focus a bit. Again, I mentioned that dual mandate, which is a wonky term, but the Fed has these two goals. One is to focus on price stability or getting inflation under control and keeping it under control. The other is trying to achieve maximum employment. And I think what you see here today is the Fed acknowledging that, making this small cut, not going as big as the president and some others have agitated for, and really going in line here again, Katie, with what Wall Street expected.
Ron, there was a pretty crazy downgrade in the jobs numbers for the 2024-2025 year from April to March of this year. And that led people to think, well, maybe they're going to cut it by a half a basis point. Why the smaller step? Why not take it not all the way. Why not take it farther, given the cooling off in the jobs market?
There's a cooling off in the jobs market, but there's not a cooling off in consumer spending. Now, Mark Zandi of Moody's Economics points out that the top 10% of wage earners are spending 49% of the dollars that are going out into the economy. So there is an uneven economy that we have, and inflation
so
still
the rich
has,
are doing well, is what you're
rich
saying.
are doing well, yes, with K-shaped economy, as they like to call it. You know, the bottom not doing as well as the top. And we also have inflation that's still stuck, and the Fed references that in its statement. And so the quarter point, widely expected, widely telegraphed. The Fed doesn't really like to surprise markets. The only person who voted for a half-point cut was Stephen Miron, who just joined the Fed yesterday.
And how do you interpret that?
He's doing the president's bidding. He is still, by the way, the head of the Council of Economic Advisors, even though he is on paid leave, which is unusual. That has not happened really since before the 1930s, that someone in the White House or in Treasury has been sitting on the board of the Federal Reserve.
Why has it not happened before?
To keep the Fed independent and separate from the political whims that come out of the White House. But this is different. He's sitting on the Fed while taking a leave from his job inside the White House. What's interesting is that Governors Lawler and Bowman, who had advocated for a July rate cut and didn't get it, voted with Jay Powell for the quarter-point cut. So the dissents were not as numerous nor as large as we'd anticipated.
All right, Justin, give me your thoughts on this.
Yeah, look, the headline that we've cut interest rates by a quarter of a percentage point is exactly what the economy required. It's what everyone's been asking for. Wall Street agrees. Conventional economic models agree. This is business as usual. But there's something I got to tell you has got my goat here. Stephen Miron's dissent. This is extremely bad news. So this is a guy who's under suspicion that he's there as Trump's boy, that he's there to undermine the independence of the central bank. The norms of the institution are it would be very unusual to dissent in your first meeting. This is the clearest possible message that he is there to do the White House's bidding. This is another brick in the wall of Fed independence that's coming down, and I'm frankly profoundly disappointed in him.
Peter, give me a little bit more about the relationship between Stephen Miron and the White House and the president.
Yeah, I mean, the justice just said, I mean, you do not normally have somebody who technically is on the White House payroll as an independent governor of the board. It's not surprising that he voted the way he did today. This is what he was sent there to do. And it's often true that presidential appointees, even if they don't maintain White House ties, newly arrived, try to push for the agenda of a president, but to dissent and leave himself on the outside is pretty unusual. Look, this is what the president's been pushing for. It's just not as much as he has pushed for, and not as early and not as extensive as he's pushed for. So he'll probably continue to pressure the Fed to do more, do go faster, right? He refers to Jay Powell as too late. Jay Powell as his way of denigrating him. But the other message here that's really interesting and kind of contradictory is the president wants to tell us the economy is doing great. At the same time, he's pushing the Fed to lower interest rates because the economy isn't doing great, because in fact it needs the juice that an interest rate cut would provide.
Katie, one of the reasons the president is pushing the Fed to lower interest rates as well is to reduce the debt service burden that the United States has. For every, 1 percentage point cut in interest rates, you reduce the payments that the Treasury has to make on the outstanding debt. And this has been one of the president's big things.
Also, the president he's a real estate guy.
Yeah.
So interest rates for him are key, because if you have an interest rate that is too high, it makes building very difficult. It makes buying properties very difficult, taking loans out very difficult. The interest rate itself has always been key to his business life.
Yeah, to a large extent. But I think in this particular instance, the cost of servicing the debt, he has referenced, on numerous occasions, and he wants it down. He would like the Fed to cut rates by 3 full percentage points down to 1% to save, quite hundreds of billions of dollars a year in debt service costs. Now, that would be wildly inflationary if the Fed were ever to acquiesce to his desire, but that doesn't seem to bother him all that much.
David, the Fed also projects an additional 50 basis point cut by the year end, perhaps another 25 basis points of cuts in the next 2 years as well. So they are projecting that they're going to continue needing to cut interest rates. Why is that?
Yeah, I'm looking here, and I think that I've got a sense here that that's inverted. Maybe one more cut this year, and then 50 basis points of cuts in the year ahead. I mean, I think that it just highlights what I was talking about, Katie, which is there is still this huge element of uncertainty surrounding the state of the U.S. economy at this point in time. And let's talk about inflation first. Again, still higher than the Fed wants it to be at. Still has a lot of stickiness, as economists are fond of saying. And there's so much uncertainty about the effect that the president's trade policies are going to have on inflation going forward. So again, there's that side of the mandate. Turning to the labor market, there's this new spate of uncertainty over sort of what's going on with the job market. We see, again, those revisions. We see the jobless numbers going up. It's posing concern here. It's presenting concern here for members of this committee. And I think looking forward here, there's a sense that, again, they're going to have to cut. I suspect what we're going to hear from the Fed chair in the next few minutes when he has his press conference is him echoing a refrain he uses over and over again, which is that this committee is going to continue to be driven by data. These recent data have been interesting, unsettling, and I think they're going to be even more paramount going forward here. I should say before the next meeting in October, we're going to get new data on inflation and the jobs market, and they're going to continue to be key here for policymakers at the Fed.
Justin, we were talking about the K-shaped economy. The rich are doing well. The not rich are not doing as well. Christine Romans and I have talked about the no hire, no fire economy. We're seeing unemployment tick up, but also people who are unemployed take longer to get reemployed. They're sitting outside of the job market for longer. Is this sort of thing, a rate cut of 25%, is that going to help businesses hire more?
Katie, it'll help, but it'll help a little bit. It'll help about a 0.25 percentage point. So, look, we spent a lot of time debating whether rates should be a 0.25 point higher or a 0.25 point lower. And what really matters is as long as they're roughly right, we're roughly in the right spot. What's more problematic is if we end up in one of these once-in-a-generation moments when an overconfident policymaker decides he or she knows better than the central bank, stacks it with their own people, and then and drives the economy off a cliff. So that's why I drew our attention back there. Katie, there's one part of this Fed statement I do want to draw your attention to. It's now official. Stagflation is here. This is the new first paragraph of the statement. Job gains have slowed and the unemployment rate has edged up. Also, inflation has moved up and remains somewhat elevated. So that's the world we're in right now.
Stagflation, define it for me one more time if you can.
Stagflation, stagnation. The real economy's not doing well. We're not creating much stuff. We're not creating jobs. Unemployment's going up. Inflation. We've got inflation at higher rates and rising. And both of those bad flavors are happening at the same time. Normally, we're used to one or the other. But when you hit the economy with supply shocks, which is what tariffs are, you get stagflation, which is both ugly things at the same time.
I can imagine you standing at a whiteboard with a marker, cutting that word in half for your class there at the University of Michigan. Your professor really came out just there, Ron.
Justin would have to also say that this is a mini stagflation relative to our lived experience in the 1970s and early 80s.
Your lived experience. Thank you very much.
Including Justin and the son. But look, in 1980, unemployment was at 11%. Inflation was at 13%. And Paul Volcker, then the chairman of the Federal Reserve, took short-term rates to 20%. That was a very different experience. It took place over a 15-year period to get that high. We're at unemployment 4.3%, inflation around 3%. It's stagflation of a sort. It's not the type that we had when I was growing up,
Yeah,
but it's still
not as bad.
uncomfortable.
I'm in my 40s now, so I can now say that this is, I don't want to be any older than I am. I don't have to pretend that I am older than I am. So now I'm going to say the 70s were yours.
Yes, they were.
I will take the 80s. Peter Baker, let me ask you how you expect the White House to respond to a cooling off economy, a K-shaped economy, stagflation, even if it's a mini version of stagflation. What do you anticipate is going to happen from the president, but also from Scott Bessent?
Yeah, I mean, the president lately has been focusing on the stock market as his indicator of success, which he does when it's doing well and he ignores when it's not, right? Because the other indicators of success are, in fact, somewhat problematic at the moment. Consumer confidence is down, inflation is going up, unemployment is going up. As Brian said, not, in a drastic way compared to the times when he was young, and frankly, I was young then too. But these indicators are the things the president's going to ignore while he talks about the market, right? Look how great the market's doing. At the same time, he's telling Americans to be patient, right? That the tariffs he has prescribed, which at the moment are in this legal fight, are someday going to provide a real boost to the economy. But that's really a hit or miss proposition, one that's debated fiercely in the halls of the University of Michigan Economics Department and elsewhere, certainly at the Fed. And even if he's right, isn't going to happen in the near term. So what he's trying to preach to Americans is something that both Americans don't particularly favor and something that Donald Trump has never really favored, which is patience. Any benefit from the policies he is prescribing are not immediate. And I think that's going to be a hard message for him to sell. So that's why you hear him go after Jay Powell. He always prefers to have somebody else he can blame bad news on. If he were allowed to do his thing, he says everything would be great. And it's really only because people like the deep state Federal Reserve Chairman are getting in his way.